Today we have enough options, right? There are so many, things to choose from, like savings, government securities, you get a windfall, cash, mortgage. You don't know what to do, how to put your money, where to put, right? Most retail common households invest very little amount of money in equities because this culture has not yet kind of come up in India. Broadly, worldwide, these are the five most common asset classes where normal investors would invest, because if you go wrong here, believe me, 90 rest all things will be messed up, and that's why I'm stressing more on this. If you're looking for a regular income, monthly income kind of thing, again, FDs or debt is a much better option. But the problem with this is that when I ask people how much you're earning in FDs, they're very happily saying, okay, I'm earning 8%. Then the question that I want to ask them, is this 8% really coming in your hand? But actually the answer is no. नजदीकी फायदा देखने से पहले दूर का नुकसान सोचना चाहिए. Get enamored by that, okay, I'm getting guaranteed return, safe. But what they forget, in the long term, this is not able to even beat inflation. And we thought FDs was like guaranteed and safe. Yes, it's guaranteed, but most of the time it is actually a guaranteed loss. In the next session, now we are going to talk about what is asset allocation and why is it important. Okay, so asset allocation is a very, very important a concept which is very macro. We have to understand why this is important in our wealth creation journey, in our personal finance and goal planning journey. So let us try and understand what does this mean. Because today we have enough options, right? There are so many things to choose from, like savings, government securities, you get a windfall, cash, mortgage. You don't know what to do, how to put your money, where to put. Okay, and this is where we have to understand what Indians have been doing so far. So if average family is, let's say, $100, how that money has been divided, and this is a report by Franklin Templeton, I think, a couple of years back. If you see this, of course, bulk of the money goes in property. Property still remains our biggest dream for a middle class Indian. Our own house on the roof, and then we want to have multiple properties if our families are becoming big. So almost 50% goes in properties. Then whatever remaining, it is around 14% is in bank FDs, which is the most safest option that people choose from. Then it is gold. Then it is insurance funds like your endowment plans, your ULIPs, your whole life plans, and then your EPF and PPF, right? Most retail common households invest very little amount of money in equities because this culture has not yet kind of come up in India. And finally, we have around 3.4% in cash. So this is how the funnel is shaped up. And total household assets in India was around $11.1 trillion, 50-50 in financial and physical assets. So physical assets are your gold and properties. Financial assets are your bank FDs, mutual funds, pension funds, insurance, all of these. So this is how Indians have broadly stacked up their assets. Okay, very important for you to understand. And this is your piggy bank, right? And in your piggy bank, you would have some amount of FDs, you would have mutual funds, real estate, equities, commodities, bank. All of these things are there. This is what is called an asset allocation. How much money you have put in all this, how your piggy bank is divided, right? That's called asset allocation. And let me now share in a little more detail that what are the five main asset classes. So let's look at this. This is very important to understand. Broadly, worldwide, these are the five most common asset classes where normal investors would invest. The first being equities, let's say. It is for long term, growth oriented, high return and risk, and highly liquid. So it is meant for long term. It is supposed to grow your capital. It is high return and risk, okay, which means it will be highly volatile, but it is highly liquid. You can withdraw it at any point of time. Then you have debt. When I say debt, you can lend your money to a bank, to a company, and generally this is for medium term, 1, 3, 5 years. You get a regular income. It is medium return, so you don't get very high returns like equities, and it is moderate risk. It is moderately liquid, which means there are FDs where you can't withdraw. There are FDs which you can withdraw at some penalty, by paying some penalty. And then you have cash, which is nothing but money lying in your house or money lying in savings account, current account. It is short term. It is meant to park your money. You earn low returns and risk, and it is highly liquid. So this is the most liquid asset class of all. And there's a difference between cash and liquid and debt, because here this money is earning little more high return, and that is why if you withdraw before that, you will pay some penalty. Then you have gold. It is cyclical again. Gold prices doesn't only go up like any other asset class. It will have its cycle. It is growth oriented. You don't get any return from gold generally, right? Apart from sovereign gold bond, which again now has stopped, you don't get any returns. Moderate risk and return, and it is highly liquid again. If you have a bar, gold coin, you can liquidate it one day. And finally, as I said, property, it is long term. You can't flip your properties every now and then. Growth and income both are there. Growth is capital appreciation. Income is your rentals. High risk and return, relatively illiquid, as you would understand. So broadly, most of us would have invested into these 5 asset classes. This more from a parking point of view. Okay. So what determines your asset allocation? Mine asset allocation would be completely different than yours, right? It depends on a lot of factors. Within the same family, 2 brothers, 2 sisters, brother and sister would have complete different asset allocation. Husband and wife may have different asset allocation, right? Because it is very personal. Just like our goals are personal, our asset allocation is also very personal. And it is very important, thing to understand that what should be your asset allocation. Because if you go wrong here, believe me, rest all things will be messed up. And that's why I'm stressing more on this. So what determines our asset allocation? Required return for a goal. So since I said we should have a goal-based investing, we should each have goals. So what is that required return? So suppose, I have a young daughter or son. They're very young right now. And after 15, 18 years, I need to fund for their education goal. So because I have a long time, with me available, so my required return might be very low because I'm starting very early. That gives me the power. But if someone is starting just 5 years before, the child turns 18, that person or that family has just 5 years window. So he has no option but to take little high risk or high return, right? So it depends on when your goal is coming, what is the required return, when you would need the money. Do you need the money in interim, or do you need money just when the goal requirement comes? So in my case, if my child's education goal is 15, 18 years down the line, I may not need this money. Okay. So that is again, that will determine what kind of asset class I can put.
You can achieve your luxury car, dream home, retirement, and all your other financial goals without taking a loan. How? Through mutual fund investing. Hi, I'm Gajendra Kothari, founder of Etika Wealth Private Limited, and I've been investing in the mutual funds for the past 15 years. I'm here on Upsurge.club with my mutual fund course to help you achieve financial freedom. In this course, I will teach you everything about mutual funds, how they work, their different types, how to analyze the mutual fund scheme, and how to select the best fund for yourself. You'll also learn how to build your mutual fund portfolio through examples. So, enroll in this free course today and start your wealth creation journey with mutual funds.
Third is investing horizon, time frame, 10 years, 15 years, 2 years, 1 year, 18 years. And finally, what kind of person you are, what risk preference. I am a person who may be willing to take much higher risk, higher volatility. Even if the prices go up and down very frequently, in the short term, I'm okay. In the medium term, I'm okay. But there are people who can't see, who are not comfortable with seeing any kind of downside. And that is why their risk tolerance is quite low. So it is very important for you to understand all of this at your level. And that is, how do you find this out? There are risk profiling questionnaires available out there with your financial advisor or distributor. You should check with them, find out what kind of person you are. That would determine what kind of investment strategy or asset allocation you should have. But broadly, the 2 main asset classes which most Indians see: property, we all know, we understand. That's why we don't have to really discuss much. Gold, again, we all know, we all understand. Apart from these 2 major asset classes, the other 2 are debt and equity, that nowadays a lot of people have started putting money. These are financial assets, but we have to understand the difference between the 2. Again, I've seen a lot of people get confused, a lot of people get this wrong. If you get this wrong, then as I said, rest all will really not help you. So debt is like your FDs or the kind of loan you've given to companies you've invested in. It's for a fixed period, right? It is always for 1 year, 2 year, 5 year kind of thing. You earn interest, right? The company or the bank would pay you interest. Interest is mandatorily paid at a fixed rate. So 6% FD, 7%, 8%. It is mandatorily paid at that rate. Debt instruments may be secured by assets. What if tomorrow that company is bust? So you would have collaterals like your house, mortgage. Okay, so those things are secured. If something were to go wrong, the company, you can liquidate the company, sell off those assets, and you will be getting your money first. And generally, the principal amount comes back to you at maturity. So after 3, 5, 7, 10 years, whatever. This is debt. In equity, you are the owner of the business, so it is perpetual. As long as the company is a going concern, you want to be the owner, you can remain as the owner. In equities, you don't earn interest, you earn dividends. Whenever a company makes profit, they may decide to give this in the form of dividend, and as a shareholder, you earn dividends. There is no rule that how much dividend the company will pay. It is paid discretionally. It depends on what kind of uh, plans the company has. If they don't have expansion plans, they have a lot of money reserves, they want to give to the shareholders in the form of dividends. Equity enjoys no such security. Unlike debt, which is secured, equity has no. You are the last person in the row to be getting the money because you choose to become the owner, right? And you wanted to go for higher upside, higher gains, and that's why you have to be taking higher downside also if the company were to go down. Equity, the value of your equity may appreciate or depreciate in value over time. Just like the stock prices we see, this is nothing but the equities that you own. It can go up and down. So my question to all of you is, who should go for debt? Who should go for equity? And why I'm asking you this question, because maximum people, when I see their portfolios, when I see their asset allocation, I see there's a huge mismatch in their expectations in the way they allocate. So first thing first, if you are a safe investor, as in you want a low risk, investment, debt is a better option. Equity is a high risk, high return game. Debt is a low risk, low return game. Equity, high risk, high return. Secondly, if you have short term tenure, 6 months, 3 months, 12 months, 2 years, 3 years, go for debt. If you're looking for long term, minimum 5 years, 7 years, 10 years, 15 years, 20 years, 25 years, go for equity. Okay, that's the second thing. Third, if you're looking for a regular income, monthly income kind of thing, again, FDs or debt is a much better option. Equities, we generally go for capital appreciation over a long period of time. Of course, the company pays dividends or all these things might come to you, but you're not looking for a regular income here. You should not depend on regular income from equities. You shouldn't. Okay. So, as I said, seek debt for income, seek equity for growth. The moment you have a complete clarity on this two, then it is much easier then to go, more deep down, a deep dive into how can we go and invest in equities and what are the different kind of options we have in debt. Now, let's first talk about the debt option. So, the most popular are fixed deposits, right? And these are fixed deposits offered by banks. So you have 1 year fixed deposit, 2 year, 3 years, 5 years. Let's talk about 5 years. So 5 years, currently the best fixed deposit options are somewhere 7.5%, right? And then you have senior citizens which are getting up to 8%. So this is what a fixed deposit offers. The most popular being bank FDs. You have NBFC fixed deposits. You have corporate fixed deposits. You can lend it to individual person. But one thing I would like to tell you, that the more returns you're getting from your lending, the more risk it is. If somebody is offering you 12%, that's really high risk because there's no paperwork, there's no guarantee. You don't know whether the money will come back or not. So this happens to be the safest form of deposits. But the problem with this is that when I ask people how much you're earning in FDs, they're very happily saying, okay, I'm earning 8%, like senior citizen. Then the question that I want to ask them is, this 8% really coming in your hand? Okay. And they get confused. They think that 8% is coming to them, but actually the answer is no. Why? 8% that you're earning is returns which the bank gives you. This is called nominal returns. Okay. But suppose you are in the higher tax bracket, you pay 30%. So 8% minus 30%, net money that comes in your hand is 5.4%. Now you might be thinking that this is the money you take home. But what we forget to minus is inflation, which again may be 7, 8, 6%. And look, as I said, what government publishes is around 5, 6%. This is not our inflation. For a middle class, upper middle class, the inflation will be 7, 8, 9% because we have a lot of discretionary requirement. Something, like every 2 years we are changing our mobile phones and stuff like that. So our inflation is much higher. And that is why after inflation and after this, the net return that we earn is actually negative many times. Okay. Because you are earning 5.4. If inflation is 6, then you're earning point 0.6 minus, right? If inflation is 7, then you're earning minus 1.6% returns every year. And we thought FDs was like guaranteed and safe. Yes, it's guaranteed, but most of the time it is actually a guaranteed loss. So my suggestion is that only if you have to do FD for short term, 6 months, 1 year, 2 years, just to park before you can use this money, okay, it might be good. From a long term perspective, like 10 years, 15 years, I've seen a lot of people do 5, 10, 15 FDs. To me, it doesn't make sense unless you have a lot of money and you're not worried about inflation risk or tax, this thing. Then maybe FDs can be a better choice. I hope you are able to make sense out of this. And I'm reminded of this wonderful dialogue from Sarkar movie where Amitabh Bachchan says, "नजदीकी फायदा देखने से पहले दूर का नुकसान सोचना चाहिए." Right? Such a valid line or dialogue when I see FDs, because people get enamored by that. Okay, I'm getting guaranteed return, safe, but what they forget in the long term, this is not able to even beat inflation, right? So this is very, very important. So we've discussed FD. Now let's discuss real estate. So real estate, again, I'm talking real estate as an investment point of view. I'm not talking real estate as a consumption. If you bought house to live in that, then that's for consumption. You can't treat that as an investment. Okay. I'm talking about scenarios where people are buying multiple properties, right? So let's look at how this works out. So in real estate, the first biggest disadvantage in a real estate is it's a very liquid investment. You can't buy and sell at your, at whenever you want. It can take 2, 3, 4, 5 years to play out. It requires a very, very high amount of corpus. So it's not suitable for everyone. Minimum amount you may require is 10 lakhs, 25 lakhs, 30 lakhs. You can't do 10,000, 20,000, 30,000 rupees investment, right? In city like Bombay and Delhi, you might even require 50 lakhs, 1 crore, 2 crore, 5 crores. So you need to be an HNI, high net worth individual, or a super HNI to invest in real estate, right? Not many low middle class people, retail common people can't invest in properties. Next is homework required. It requires a much longer time horizon also, because 3 years, 5 years, 10 years, 15 years, this is what kind of time frame you have to give for your real estate to play out. One of the most again important reason is the homework required in real estate is very high. Every city is different. It's not like a standardized product. It's not like gold. It's not like FDs or equities. Key you can buy anywhere in India at the same price. Every price within the city, it is very different. So it is very high. Due diligence on builders. Who is the builder? Lengthy documentation, clear title. This is again a big problem. Okay, in India we saw in India, I think this is a big problem. We saw this movie Khosla Ka Ghosla around 15 years back, and these are the challenges that you see in real estate. At times it takes a year to decide and close the investment. Okay, it's not easy as you see. The homework has to be very, very rigorous. Another challenge with property is that the returns are not comparable. So you can't compare the return of a property within the same building, because if one flat is sea facing and the other flat is a garden facing, it will have completely different rates. The flat on the 50th floor will have a completely different rate than the flat on the 30th floor, and there could be 20% difference within the two, right? So it is not comparable. The return on one property cannot be compared to another property, and there's no authentic data available, right? very few times you are able to get this data publicly at what price this was quoted. Again, it's because it's a kind of a balance between the demand and supply, between the buyer and the seller. So it's very difficult to find standardized prices. Transaction costs are very high. Stamp duty, broker fees, legal charges on real estate is very high. When it comes to taxation, again, it is not very favorable. You have to pay short-term capital gain and long-term capital gains tax. Transparency is missing. Again, the biggest challenge with the properties, transparency is missing. You know, what you're promised is the moon, what you really get is something very different. The issues with real estate is we only come to know afterwards. You know, in this society, water problems are there, or air is polluted, or you know, the kind of people who live there are very different and stuff like that. So transparency is missing, and a lot of unaccounted money flows there, and that is why it is very difficult to manage. Politicians influence, again, a lot of times with your agricultural lands, with your farmhouses, with stuff like this, you don't have control. And so why I'm talking about this from a common person's point of view, it becomes very difficult to manage property, right? So of course property can also give very high returns, no doubt about that. It can give you rental incomes also, but these are the challenges that you have to understand with real estate. One piece of advice to young people, as Ritesh Agarwal says, you can't become rich by buying a house in your 20s, right? Stay in a rented apartment and invest like crazy. 20s is all about taking risk. So this is a very piece of advice, very, very important piece of advice coming up. And somewhere down the line, I'll give you another piece of advice when it comes to real estate for most young people. But please take this seriously. I really, I have been practicing this, and I can't tell you more, on the virtues of being on a rental property early years in your life. That gives you far more flexibility. But please, I think this is very, very critical to people who are in 20s and 30s. Now let's talk about the next item, which is gold. So we discussed FDs, we discussed properties, and now let's discuss gold. This is a wonderful chart from Funds India. They compile this on a very monthly basis. Amazing data points. You can go and check out on the website. So they have plotted the gold returns for the last many years. Okay, gold returns have beaten inflation in the long term. Okay, but goes through long intermittent periods of subdued returns. So while gold in the long term have given positive returns, but there are a lot of periods when gold has done nothing. Right, from January 80 to January 90, gold had done nothing. Okay, the prices were flat, and we are talking about in rupee terms, not in dollar. Dollar was even worse. At least there is an advantage of rupee depreciation every year by 3.5%. So that is why you see the advantage in gold. Again, from 96 to 2002, gold went nowhere. Somewhere 11 to 19, gold did nothing again. So, and I'm talking about large, long periods. So, if you see the returns of gold, 10 years, the returns have been around 11% per annum, 13%, 30 years, 10%, 40 years, 10%, which means over a long period of time, gold has beaten fixed deposits. Okay, gold has given very comparative results compared to properties also, because properties as a basket has also given this kind of return across India as a basket. I'm not talking about individual properties that you own, because that can be very subjective and different. But as a basket, gold has beaten properties, and there are data points to prove that. But having said that, gold also goes through long periods of underperformance, and this is quite important for you to understand. Okay, but it has proven to beat inflation. So this is very interesting. As I said, these are the three different time periods where gold did nothing, and the latest being September 12 to June 19. This is INR price. It took almost 7 years for the price to beat. So gold also has its own cycles. You have to understand where are you in the cycle. So currently, if we see the current cycle today, gold is quite on the high rise, because in last 1 year gold has come up by 30%. I think in the previous slide, if you see, look at the rise of gold in the last in 24 itself, right? The price has been quite steep. So of course it can continue to go up from here, or it might remain flat for a longer period of time. Or sometimes in the short term, it might correct sharply also, as you can see here, right? It can correct. If it has gone up too fast, too soon, it might correct also. So what are the takeaways from investment as gold? Over the long time periods, 10 to 15 years, gold has provided returns above inflation. So that's a good news. It is able to beat inflation. Long-term return expectations in gold should be plus 1 to 3%, plus minus 1 to 3% generally. So if inflation is 7-8%, it should be 10, 11, 12% kind of thing. Gold also goes through extended interim periods of subdued returns, which means there are periods of 3 years, 5 years, 7 years where nothing will happen. And gold in India, at least you are having this advantage of USD INR depreciation every year by 2 to 3 or 4%, and that is why you're seeing appreciation in gold price to that extent.